In the world of finance, we are constantly bombarded with news about short-term market volatility, hot stocks, and immediate gains. This noise encourages a dangerous habit: emotional, impulsive decision-making. But true wealth is not built in a day, a month, or even a year. It is built by mastering a single, high-value asset that requires no complex formula or brokerage account. Patience. Lesson 7 is about cultivating this financial patience. It means adopting a long-term view that prioritizes time in the market over attempting to time the market. This mindset is essential for allowing the power of compounding to fully materialize over the course of your life. Many investors try to predict short-term market fluctuations, selling before a downturn and buying before a rise. This is called market timing, and it is widely considered futile. The evidence is clear: consistently attempting to guess the top or bottom of the market usually leads to missed opportunities and increased costs. If you miss just the 10 best performing days over a 20-year period, your returns can be drastically lower than an investor who simply bought and held through every high and every low. Financial maturity requires simplifying your investment approach and resisting the urge to react impulsively to fleeting news cycles. By focusing on your long-term goal, you minimize the emotional damage caused by short-term volatility, which is a normal, unavoidable function of the economy. The world's greatest investors champion patience. Warren Buffett, the Oracle of Omaha, famously articulated this investment creed: "Our favorite holding period is forever." Buffett's success wasn't built on trading stocks daily. It was built on selecting high-quality assets and committing to hold them for decades. He understood the concept of the patience premium, that investors willing to sit still and ride out temporary drops are rewarded with significantly greater long-term returns. Think of it like being an owner of a highly successful business. If the market value of your business temporarily dips 15% due to a competitor's news, you wouldn't panic and sell the whole company. You would assess the fundamentals applied to your portfolio. Patience means trusting your initial analysis, sticking to a diversified plan, and allowing the intrinsic value of your assets to grow. Patience is vital because it protects the most valuable ingredient in wealth creation: time. Time is the non-renewable fuel for compound interest. The longer your money stays invested, the more years your returns have to earn returns of their own, leading to exponential growth. For instance, studies show that a large initial investment, delayed by just 5 years, can result in a sacrifice of over $53,000 in potential growth over a 20-year period. This is the opportunity cost of waiting, an irreversible loss created purely by a lack of patience to begin investing immediately. The long-term perspective allows you to harness the historical tendency of the stock market to produce positive returns over extended periods, making disciplined, regular investment superior to speculative, reactive timing. Financial patience is not passive. It is an active discipline. It is a defense against one of the most dangerous behavioral biases in finance: loss aversion, where the emotional pain of a temporary loss causes investors to panic sell at the worst possible moment. Your actionable step is to create a long-term plan, e.g., investing for 30 years, and then commit to that plan regardless of the short-term noise. Don't check your portfolio daily. That only invites emotional reactions. Instead, focus on 2 core metrics: maintaining your consistent automated contributions and monitoring the consistency of your overall asset allocation. By focusing on time, consistency, and a long-term view, you adopt the mindset of the wealthiest investors and unlock the patience premium, allowing you to ride the market cycles all the way to financial independence.